Well, in one of your YouTube videos, you actually said that you're currently $600 million in debt. No?
1.2 billion.
1.2 billion, okay. There we go.
The idea that our money grows in a bank is not entirely true. What? Although the number may increase due to interest, its actual value doesn't grow in real terms, especially with high inflation. Your money loses value over time in a bank. So in this video, we'll reveal 5 alternatives to keeping cash that can be more beneficial. These assets have the potential to preserve or even increase in value, offering a better option than just holding on to cash. In a world where banks offer low interest rates and economic events are unpredictable, stashing your money in a bank account might not be the smartest way to grow and protect your wealth. Cash doesn't hold as much weight nowadays. Instead, a more effective strategy involves having a diverse mix of assets that can provide better returns and safety compared to traditional cash savings. While having cash is handy for everyday transactions, having large sums for the long term can be risky due to inflation. On average, prices tend to rise by about 3% each year, which means the value of your cash diminishes over time. To ensure your wealth stays secure and keeps up with inflation, it's wise to spread your investments across assets that have the potential to grow and offer better returns. Now, let's explore 5 assets that have a track record of outperforming cash savings in terms of safety and return on investment. Number 1. Precious metals. Precious metals like gold and silver have proven to be enduring and valuable over time. Unlike regular currencies influenced by government policies, these metals maintain their value, serving as a safeguard during economic uncertainties. Gold especially acts as a shield against inflation. When other assets lose value due to negative returns, precious metal retains its worth as a physical asset, immune to fiat currency correction. As living costs rise, so does the value of gold, protecting owners from the eroding effects of inflation. Gold can safeguard against currency risk. If a currency's value drops significantly, the price of gold in that currency tends to rise. This is beneficial for those in countries with unstable or hyperinflationary economies. Precious metal performance differs from stocks and bonds, making it a valuable tool for diversifying an investment portfolio. Recognized globally for its value for thousands of years, gold remains universally accepted, even if the value of fiat currencies decreases. Unlike fiat currencies, the supply of metal is limited. This scarcity contributes to maintaining its value. While gold offers these advantages, it comes with risks. Its price can be volatile. Like any investment, careful consideration of these factors is important before buying. Number 2, the S&P 500 Index. Investing in the S&P 500 Index instead of keeping cash is often better, mainly because of the potential for higher returns and the magic of compounding. The S&P 500 represents 500 big companies from various industries in the U.S. This broad range reduces the risk linked to individual companies or sectors performing poorly. Over a long period, the S&P 500 has given much better returns compared to just keeping cash in a regular savings account. On average, it has delivered around 10% annually before adjusting for inflation, including both capital gains and dividends. Investing in an S&P 500 index fund is a hands-off approach. You don't need to spend much time or know a lot about individual companies, making it simpler for those who prefer a more straightforward investment method. Many companies in the S&P 500 pay dividends, giving investors an income source that can be reinvested to invest and grow even more. Over time, the S&P 500 has consistently increased in value, offering the potential for significant capital gains. Investing in stocks can help guard against the effects of inflation. As businesses raise prices over time, their profits and stock prices tend to go up. Reinvesting dividends combined with the long-term growth trend means your investment can grow big over time thanks to compounding. Number 3, real estate and land. Owning real estate offers many advantages compared to keeping money in a bank. Real estate usually becomes more valuable over a long period, even though prices might go up and down in the short term. Renting out your property can provide a reliable income, often higher than what you'd earn from keeping cash in a bank. This income can help cover your property expenses and become a steady source of money, especially in retirement. Real estate is also a good way to protect against inflation. As the cost of goods and services goes up, so does the value of property and the income you get from renting it out. Real estate investors can benefit from tax deductions like mortgage interest and property taxes. Some countries even offer tax benefits when you sell your primary residence. Real estate allows you to use borrowed money, known as leverage, to increase your potential returns. With a mortgage, you can buy a more valuable property than you could afford with just your own money. If the property's value goes up, your return is based on the total property value, not just your initial investment. Real estate stands out from many other investments because it's a tangible asset that you can control and enhance. You have the power to improve the property, increase its value, or adapt it to better suit your needs or market demands. Including real estate in your investment mix adds diversity and lowers risk since its performance isn't directly tied to stock or bond markets. However, like any investment, real estate has its downsides. It involves ongoing maintenance and repairs, isn't as quickly turned into cash as some other investments, and is influenced by factors like changes in the neighborhood or the overall real estate market. To make informed decisions, thorough research and possibly consulting with a real estate professional before diving into real estate investments are important. Similar to real estate, owning land can have advantages compared to keeping money in a bank. Land often increases in value over time, especially in growing or developing areas. While not guaranteed, the appreciation of land is influenced by factors like location, zoning, and the overall demand for land in the region. Unlike properties, land doesn't depreciate due to wear and tear or age, adding to its appeal as a long-term investment. Land, based on its location and features, can be a source of income. It can be leased for various purposes like farming, timber production, mineral extraction, oil drilling, natural gas wells, or even developed for rental properties. Unlike buildings or homes, vacant land usually demands less maintenance and has fewer associated costs. There are no utility bills, mortgage insurance, or expenses for maintenance and repairs. Number 4. Industrial commodities, raw materials. Investing in industrial commodities, such as raw materials like cobalt, silver, and copper that play crucial roles in various industries, is more beneficial than keeping your money in the bank. Cobalt is a vital component in rechargeable batteries, making it a key player in the booming electric vehicle industry. With the increasing popularity of electric cars and renewable energy storage, the demand for cobalt is expected to rise. Silver has diverse applications, from jewelry and coins to electronics and solar panels. It's also used in the medical field and for various industrial purposes. The demand for silver is influenced by economic activities, technological advancements, and its role as a precious metal. On the other hand, copper is a versatile metal widely used in construction, electronics, and power generation. It's a key material for wiring and plumbing. Economic growth, urbanization, and infrastructure development drive the demand for copper. Including these commodities in your investment portfolio diversifies your holdings beyond traditional stocks and bonds. Industrial commodities often have a global market, so their demand is influenced by international factors. Some investors turn to commodities like silver and copper as a hedge against inflation. We also have commodities such as oil, natural gas, agricultural products, and more. Prices of industrial commodities can be volatile, influenced by factors like global economic conditions and geopolitical events. Shifts in supply, such as new mining operations, and changes in demand can impact prices. Understanding the specific factors influencing each commodity's market is very important. Before diving into industrial commodity investments, make sure you carry out thorough research and possibly talk to financial experts who can help you navigate the complexities of this market. Keep in mind that commodity investments come with their own set of risks, and it's important to align them with your overall investment strategy and risk tolerance. Number 5. Treasury inflation-protected securities. Investing in Treasury inflation-protected securities might be a smarter choice than keeping your money in a bank. TIPS lives up to its name by safeguarding your investment against the rising cost of living. The main amount you invest in TIPS increases as prices go up, tracked by the Consumer Price Index. This ensures that your investment keeps its purchasing power. When TIPS reaches maturity, you get back the adjusted principal or the original amount, whichever is more. TIPS also pays interest at a fixed rate twice a year. This interest is added to the adjusted principal, so both the main amount and interest payments go up with inflation. While the income from TIPS is steady, it's not huge. Tips are given out by the U.S. Treasury, making them a safe investment because they're backed by the U.S. government's ability to collect taxes. This makes them attractive, especially for those who don't want a lot of risk. Even though tips might not give as much return as stocks or corporate bonds, they often offer more than a regular savings account, especially when inflation is rising. You can buy and sell tips in the market, which adds some flexibility, although it's not as easy as with regular Treasury bonds. You can get tips directly from the U.S. Treasury in amounts as small as $100, making them doable for individual investors. There are also tips exchange-traded funds available. Tips, like all investments, have some downsides. They work better when prices are going up. If prices go down, the main amount you invested might shrink, but when tips finishes, you'll get back at least what you put in. Also, if you sell tips before they finish, the amount you get can change, and you might not get it all. So, before choosing tips or any investment, think about what you want and how much risk you're comfortable with. Keeping money in a bank is not the best way to grow your wealth. It's important to explore different ways to increase your money. While these options have advantages, they also come with risks. So, when deciding where to put your money, carefully do your research and diversify your investments. Which asset would you like to invest in? Leave a comment below. And if you enjoyed this video, like and hit that subscribe button for more valuable financial insights. And thanks for watching.